Hey, good morning, options traders, and welcome back, everyone. Well, this video comes to us in response to a question that one of our very own traders posted in the group asking, can I get assigned on an out of the money call if it was previously in the money? And so he was saying that he's fairly new to options, was experimenting with covered calls, and he was wondering if this call happens to go in the money, let's say prior to expiration, but then slides back out of the money going into the closing bell, could he get assigned? Well, we're going to find out that doesn't really matter, but could you get assigned on an out of the money option? And the answer is potentially yes. Like I say, there's always a lot of moving parts with every options question, all of the answers, and so they're never as easy as they seem. So let's go find out why it's possible to get assigned on an out of the money option. Before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So his question, again, was with a covered call, but it would apply to any short option. It could be part of a vertical spread or a diagonal spread, but I'm just going to use the covered call for this example. So remember with a covered call that you buy 100 shares, or maybe you already own the shares, and you will sell one call. And it's going to be in a 1-to-1 ratio. So that means for every 100 shares, you could write one call. You're not required to. You could have 500 shares and write one call, but you couldn't write 6 calls because now that would leave an uncovered or naked call. So they're generally done in this 1-to-1 ratio. And when you do that, remember that a short option has an obligation. And in this case, you would have the potential obligation to sell your shares for the strike price. So I say potential obligation as a reminder to traders because this is not a futures contract. It's not guaranteed. And a lot of times new traders say, boy, this is like a great strategy. I can buy stock at 100. I can sell the 110 call and be guaranteed to get 110 for my shares. Well, if that were only true, that would be such a great strategy. The reality is it's a potential obligation because it depends on if the long call buyer exercises. And of course, they're not going to exercise unless it's advantageous. In other words, if that call is in the money. Now, when you sell this call option, you will receive cash. And this cash that you get acts as a small downside hedge. So if you have stock at 100 and you sell this call for $1, then technically the stock could fall $1 to 99 and you would just break even. That's the real motivation for selling a call, is that it provides a little bit of a downside hedge. So whenever you're using covered calls, your outlook should be neutral to slightly bullish. That's also important. A lot of new traders think that you are bearish because they hear that selling calls is bearish. So they sell calls against their stock and they're cheering for it. Come on, baby, fall. I want to see a fall. No, you don't, because overall you will lose. That's a positive delta position, at least for the most part. And so if it falls, you're going to be taking far bigger losses than that downside hedge will guard against. So you are looking for the stock to either sit fairly quiet, in other words, neutral, or maybe go up slightly. Now, it doesn't really hurt if it goes to the moon. It's just that that wouldn't be your outlook. And the reason is this is your risk graph. So here's our bend at the 100 strike that we sold. You can see that we have all of this unlimited downside. These are your positive deltas down here, so you definitely don't want to see that stock fall. However, if the stock gets above the strike, we go flat. And that's because it doesn't matter how high that stock's price goes, you're going to get assigned and sell for 100. That's the most you're going to receive. So in this example, it looks like we sold the $100 call for 5, which means that the maximum gain is 5. You can see it right there. That's where the top of that graph lines up. And that means that our downside hedge is right here at 95. That's where it crosses 0. So we could afford to have the stock fall from its current $100 price down to 95 and just break even. But again, you have to remember before you enter the covered call strategy that you are willing to hold the shares because you are assuming all of that downside risk. So don't get focused on, oh, I can get this instant $500 in my pocket. The reason you're doing that is that you are acting as the insurance company to the call buyer. That person wants to control your shares, but they want you to hold all of the downside risk. So that's a little background of the covered call. But now this person's question was, let's say that if the stock is up here somewhere, yes, if you're above this strike, you're going to get assigned at expiration, at least most likely. But what if it's down here, if it's just below the strike? Or maybe it was above the strike and then falls below the strike? And the answer is that it really depends. And the reason is that when you are long options, whether calls or puts, remember that long options have rights. Long options may be exercised at any time for any reason. Now remember, when you sell the option, you're the short position. You have an obligation if the long option chooses to exercise. It's up to them to pull the trigger and say, yes, I want to exercise. And that's when you could get assigned. You can't call your broker and say, I'd like to get assigned now, because that would be a right. And when you're the short option, you have a potential obligation. So once you understand that long options have rights, they can exercise at any time for any reason, whether it makes sense or not, you'll realize that an option's current moneyness, now moneyness is a collective term for being in the money, at the money, or out of the money. So an option's current moneyness or previous moneyness has no bearing on whether it's eligible for exercise. Now it has a lot of bearing on whether it's likely to be exercised, but that wasn't really this person's question. He was just asking, could it happen? So yes, it's true that if an option is out of the money, it makes no financial sense to exercise, at least in most cases, as we'll see, but that doesn't mean it can't be exercised. So always remember that. If your question is, can it be exercised? Yes, it can. But if you get assigned early, it's a gift. Now, why is that? So the point is, it really shouldn't be a concern or a fear. Well, let's go back to our risk graph. And in this example, we saw that the maximum gain was $5. So you're only going to receive that if the stock is above this strike, up in this region somewhere. Well, if it's anywhere below here, whether it's at 99.99 or at 95 or down here, the point is that you don't know if it's going to get to this maximum gain. It might, but it's uncertain. However, if you get assigned, now it becomes 100% certain. So what's the problem? When you entered the position, you knew that the very best it could do was $5, but it was a big question mark. You didn't know if it was going to happen. And now that it happens, people panic and they go, oh my gosh, I got assigned early. Well, that's a gift. You should send the guy a thank you card and say, I got all of my money guaranteed and I got it early. Right? All things being equal, when we're talking about financial cash flows, you'd rather receive money earlier rather than later because you can invest it. The sooner it gets invested, the sooner it can start earning interest. So this person now gave you the $5 early and with 100% certainty. But when it was out of the money, you didn't know. So that's why we tell people, don't worry about it. If you get assigned early, it's a gift. Now, the next logical question is, all right, I understand that it's possible to be assigned early, but why would anybody exercise out of the money calls? Well, again, it generally doesn't make any financial sense. Why would you exercise a call and pay 100 if the stock is trading for 99? And again, in most cases, you wouldn't. But that doesn't mean that there are no cases. The two most common are going to be for after-hours news and if you have large trades, let's say with a hedge fund that's holding a very large number of contracts. So let's take a look at the first one here, after-hours news. Let's say that the stock closes at 99 or just some number below our 100 strike, and you are short the 100 call. Now, after hours, the stock is trading for 110. So maybe it had a good earnings announcement or an FDA announcement, phase 3 clinical trials, or it's a buyout. Something happened after hours. So the point to see is that, yeah, you can't buy or sell an option after the closing bell, but you can exercise it. So exercise instructions may be submitted up to 5:30 p.m. Eastern Time. Market closes at 4 p.m., so there's an extra hour and a half window here. Now, little side note, this is according to the OCC standards, the Options Clearing Corp, but that doesn't mean that your broker must abide by them. So if you think that this is a possibility, something that you might do in the future, call the broker and ask, what is the latest time that I can submit exercise instructions? But no broker would be able to go beyond this. They can make rules stricter, they just can't relax them. So just make sure that that is the cutoff time that your broker has. So what could you do in this case? Well, some traders are going to look at this and go, wow, look at this trading at 110. It closed at 99, and I'd love to sell my stock right now, but there's no guarantees that it's going to be trading for 110 on the opening bell. In fact, it might even slip below. So you know what I could do is I can short the stock and exercise the call. By shorting the stock, I can get the current price in the after hours at 110. So I've got 110 bucks cash. From that 110, I exercise the call and pay 100, and there is my $10 worth of intrinsic value. It's locked up, stuck in a safe, can't be taken away. See, if I wait for the opening bell, this might not be true. Now, of course, it might be even higher, but that's not a risk, that's a benefit. The risk is that it drops. So some traders are going to short the stock and exercise the call, even though you're sitting here going, oh, there's no way I'm going to get assigned because the stock closed at 99. Well, that's just not true. There might be something that happened after hours that gives people the incentive to exercise that call. Now, that's our first possibility, something with after hours news. What's the second reason that you might see somebody exercise an out of the money call? Well, as I briefly mentioned, that could be with large trades. Let's say that you have a hedge fund that buys 10,000 $100 calls. Well, that's controlling 1 million shares of stock. And so here we come up to expiration day and the stock is trading for $99.95, and you're thinking, hey, it closed at $99.95. I'm not going to get assigned on Monday morning on my shares. On my covered call here, I'll still have my shares on Monday morning. Well, not necessarily. The fund is looking at this going, you know what? We're going into the closing bell. Stock is just under 100, but if we put in a market order for 1 million shares, it could easily rise above 100. Who knows? We might pay $101 or $103 per share. And it's really hard to say. It would depend on the liquidity, depends on what we call the marginal pairs. We just don't know. So the fund might be looking at this going, you know what? The odds are better by exercising and paying the $100 strike with certainty. And now we've got a nice, even $100 cost basis on all million shares. Otherwise, we might get 100,000 shares at $99.95. We might get some at $100.10, some at $101. Who knows? And then the average cost basis ends up going out to 4 and 5 decimals. Sometimes that can just be a real headache to try to track. But now it becomes nice and neat. $100 for all million shares with certainty. Now, is there a cost to that? Sure. That little 5-cent difference right there is $50,000 on 1 million shares. But that's the risk. Do you pay the $50,000 penalty, so to speak, by paying $100 instead of $99.95? Well, a lot of people will, because they'll say it's not certain that we can get filled at $99.95. So there's another reason that you might see your covered call with the stock something below your strike, in this case $100, and still get assigned. Now, another side note, is this going to be true if the stock is 99 or 95? Probably not. It would have to be something pretty close to that strike. But again, this is where a lot of new traders will say, oh, look at this. The stock closed almost right up to my strike. Absolutely the best possible condition for a covered call, and I'll still have my shares on Monday morning. Be careful, if it's just underneath that strike, you might get assigned. So the bottom line is avoiding assignment. If there's some reason that you don't want to get assigned, buy back the options. And that's because assignments are always done after the closing bell. So if you buy back the options, which obviously have to be done before the closing bell, then you're not part of the pool that has open contracts. Now, a little side note here again, just for the new traders who are probably wondering, how do I get paired with somebody? Who is the person that I sold the option to? Well, it's really a very slick system. The answer is you didn't. Now, a lot of times in teaching, we'll say, well, the person that bought the $100 call from you, as if there's another person that you're actually tied to with this trade. That's not the way it works. Here's the way that it works. Let's go back to the Options Clearing Corporation, the OCC, and this is a highly capitalized and regulated clearing firm. And the way that it works is that the OCC acts as the buyer to every seller and the seller to every buyer. And what's interesting is that since 1973, when options first started trading, not a single default has occurred from exercising options. So that wouldn't be true if you had to get paired with an individual trader. That person might say, hey, look, I'm not selling my shares for 100 when they're trading at 120 or 150. Take me to court. That would happen a lot. But the reason it doesn't happen is that that's not the way the system works. You are not tied to an individual trader when you initiate the trade. Instead, here's the way that it works. Let's say that you've got this $100 call and you submit exercise instructions with your broker, which is usually just the click of a button on the platform or a simple phone call. The broker, in turn, submits these instructions to the OCC, and you are, of course, going to be debited $100 cash, or $10,000 for the entire position. Now, the OCC, in turn, has a randomization process, and they will find all of the brokers who have traders who are short this call. And so they might say, all right, we've got E-Trade, Schwab, Fidelity, Merrill Lynch. They'll have this long list, and they're going to randomly pick one. And so they say, okay, E-Trade, you're it. So E-Trade now does a similar process. E-Trade looks at all of the traders who are short that call, and they have to randomly pick somebody. They can also do a first in, first out, but it's basically where the firm can't go and specify and pick somebody out. It's got to be some type of a random process. And so they go, okay, Trader Joe, you get assigned. So Trader Joe now gets credited with your $100 cash, but they're going to debit him for the 100 shares, and they're going to credit your account. So it's only after you submit exercise instructions that we actually can pair up with somebody. And the OCC and the brokers know, in this case, Trader Joe has kept his account in good standing. If there's any margin calls, they've been met. Otherwise, we've closed it down to make sure that there's no discrepancies in the cash or the number of shares. And that's why we know that these trades will go through. Okay, so I hope that helps to answer your question. Like most options questions, the answers are a lot more involved and twisted and in-depth than you might otherwise think. But if you have other questions about this, please post them, and we'll make sure that you understand it. Because it makes no sense to trade options trying to learn this stuff the hard way. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.